Hey folks, David Frost, MyStrategicForecast.com. Welcome for another episode of Common Sense Technical Analysis. Today is Wednesday, June 18th, 2014. You're looking at a chart of the SPY. Today was a relatively larger, in the big scheme of things, up day on the back of the Fed meeting, an announcement which was basically, we're continuing to taper another $10 billion. We're going to print money as long as it takes. And basically, I think Janet Yellen realizes she's in a pickle. There's really no way out, but all in all, you have to recognize that even if the market breaks or when the market breaks and sells off for a while, the Fed always has the power of the printing press, and they're always going to try and inflate the markets. So it's hard to kill a bear. It's hard to kill a bull. So you have to keep in mind that as long as the Fed believes that they can inflate asset prices, including everything across all the markets, they're going to continue to try. And even when the market pulls back 5 or 10 or 15 or 20%, they're still going to start another program of money printing. So just be aware that that's going to be the catalyst for the next turn and a bottoming for an interim, 2, 3, 4 month period of time after the market finally pulls back. But we'll get into that as it comes. The date is coming. It's going to happen in July, and we're getting closer. And as we get closer, my members will know exactly when that date is and how to play it. And we're basically going to get, more aggressive on the downside of the market. So we're going to get more aggressive on the short side or the inverse fund side and a bunch of other types of investments. So basically, another light volume day, and the market floated up after the Fed meeting. What a great excuse. Buy program comes in. They push the market around, inflate it up, asset inflation, inflate the markets up. Happy-go-lucky, get the pom-poms out, and that's what we had today. And that's typical for, a Fed meeting, for an excuse to send the market higher after the meeting. I said yesterday, or I think it was the day before, I said expect Wednesday to be up after the Fed announcement. The market will whip around for a while, and then it'll finish up, and that's exactly what happens. It just happens more often than not, and that's where the common sense analysis comes in. We're looking at the technicals. We're in a bull market. There's light volume. There's no bearish signs whatsoever. You have a Fed announcement. There's no reason on earth the market was going to go down, and that's just the way it goes. That's the way it rolls. So, what I said the other day, and I'll repeat again, is you're probably going to have maybe retrace about half of this volume, maybe tomorrow even, maybe down 5, 6, 7 points, something like that on the S&P, or maybe even just a pause day even, and then another pause day on Friday, maybe slightly up, and then you have the summer solstice on Saturday, which would normally signify a turn in the market. So if that plays out that way and the market floats up into the end of the week, you can expect some kind of a pullback early next week. That's my take as it stands now, but we'll see how it unfolds during the week, and we'll see, how we want to play it with various swing trades to members. Let's take a look at the bond market real quick, and here's the 10-year yield, which was down 0.4 of a basis point, or 4 ticks today. So basically, it's just chopping around, but this is bullish consolidation, and I still think we go higher. And I think we're going to, go into this range here, 265, 6, 7, 8, something like that, before we see another pause. Later on, I think there's higher yields to come, but not right now. I think that's about the max move right now, and we'll see how that goes. And the 30-year looks relatively close to the same. I think the 30-year has an upside of about 350, give or take. This pivot high here is a really good target, and we'll see how that plays out. So we're just up and down. Today we were down a little bit. We'll see what tomorrow brings, but there's no trade currently. I'm already in the TBT. I've told you guys that, on these public videos that, I am short the bond market, but I'm looking to, at least exit half that trade when we get to those targets, and we'll see what the pattern looks like at that time. And I'll let you guys know what I'm doing. So let's go over to the oil market. Same routine. We're not short oil. We're not long oil. Maybe the upside in the USO, this is USO, is 50 cents to $1. And the upside in crude, which is, maybe 108 to 110. So we'll use 109 plus or minus as a good target on the interim basis. There's no short in oil. There's no long in oil. The risk reward isn't there. You have the geopolitical forces. We don't want to get in front. So as a result, we leave it alone. There will be a short on oil sometime in July. I'm pretty confident of that. Let's go take a look at the gold market. We'll look at GLD, and GLD was up slightly today, 39 cents. I still say that your upside target is about 124.5 to 125, and that's about it on the GLD right now. I think there's lower prices ahead. There's lower prices into July, at which point I expect to see a better low, and hopefully if the pattern dictates, we're going to take a long position not only in the GLD, but the members will also get some trade alerts on whether it's GDX itself or some of the miners within GDX. So I've got that on my radar screen. I'm watching, and when the time is right, we'll pull the trigger on those. What else do we have tonight? I think that's about all I wanted to cover. Just remember, light volume, the float continues, the melt up continues. There certainly could be more upside to the market, and we're just not ready to turn down yet, so you have to be careful. Don't be impatient trading the markets. This is your Common Sense Technical Analysis. I'm David Frost. Thanks for tuning in, and we'll see you on the charts.